When you're saving money through your job, one of the most important decisions you make is whether to use the Roth 401k or the traditional 401k option. And this can be a really big deal. It affects not only your take home pay and your taxes today, but it also affects your finances in retirement. For example, this decision can impact how much tax you pay in retirement, how much of your Social Security is going to be taxed, as well as what you pay in premiums for health care and other things. And by the way, this can apply to other types of plans as well, including 403b or 457 or the TSP if you have the Roth option there. So the good news is you don't necessarily have to choose one over the other. You can do either Roth or traditional or some combination of both, but one of these options might be substantially better for you. So that's what we'll cover in the next couple of minutes. We'll talk about how the different contribution types work and review some pros and cons, and then get into which one you should choose based on what you have going on. So the question of Roth 401k contributions versus traditional comes down to taxes, when you pay the taxes, today or later. With Roth, you pay income taxes on all of your income today, but if things go well, you can potentially get tax-free income in retirement. With the traditional contributions, on the other hand, you get a break on your taxes today, but you would need to eventually pay taxes when you take withdrawals from those pre-tax accounts. So why does this matter? Well, it may seem intuitive to get that tax break today so that you don't have to pay taxes on all of your income this year. The clients I work with often view it that way, but when we look at the distributions and your actual income in retirement, it can get a little bit more complicated. So one example is that the income tax bracket you're in retirement might be different from your tax bracket today. And so if you can get a higher or lower tax bracket, sometimes it makes sense to pick one or the other. Also, depending on your income in retirement, if it reaches above certain thresholds, it may cause your Social Security income to become taxable, and effectively that's a tax increase, leaving you with less money to spend in retirement. And a third issue might be healthcare premiums. So if you, again, get above certain thresholds or you're moving along certain ranges, you're going to pay more for your premiums, whether you're using a privately paid plan through the healthcare exchange or once you're on Medicare after age 65. There are a variety of other things on your tax return that your income depend on as well, so you might not qualify for certain deductions or tax credits if your income gets high. So this is why it matters to pick one over the other. Keep in mind that this is an optional feature and it's not available in every 401k, so it depends if your employer chose to add this feature. And if you don't have it right now, you can always ask the employer to add it. If your plan does allow these Roth 401k contributions, then you can choose if you want to put all of it toward Roth or all of it toward the traditional pre-tax or do some sort of mixing. So for example, in 2023, the maximum salary deferral contribution that you can put in out of your pay is $22,500. So you could do all of that to Roth, all of that to traditional. You could do 11,000 and 11,000 or 14,000 and 8,500, however you want to do it. It just depends on how much income you want to take this year and how much you want to set aside for, ideally, tax-free income in retirement. It can be easy to confuse a Roth 401k with a Roth IRA or even the traditional account. So there are some important differences. In particular, we can start with distributions. When you take distributions from a Roth 401k, it's not quite as flexible as it would be with a Roth IRA. So Roth IRA lets you pull out your regular contributions at any time with no taxes and no penalties before you ever get into the earnings, which would potentially be taxable and might have penalties. But with Roth 401k, you're required to take the money out pro rata. In other words, if you have some earnings in your Roth 401k, you're going to have to pull those out along with your contributions. And so those earnings could potentially have taxes and penalties. That said, the 401k makes it a lot easier to either contribute to Roth or to get a pre-tax contribution into the 401k. And that's because you don't have to worry about what your income is. With an IRA, sometimes if your income is too high, you cannot contribute to a Roth IRA, or you might not be able to make a deductible pre-tax IRA contribution. But with a 401k, as long as your plan allows either type of contribution, you can go ahead and make it as long as you have the income. If you're already familiar with the traditional 401k, there are some things about Roth 401k that aren't really different. So for starters, there's matching. If you contribute to a Roth 401k, you're eligible to get that employer match. Same as before if you were contributing to that traditional pre-tax 401k. Choosing Roth doesn't eliminate the ability to get a match. You also have the same access to funds. So for example, in both cases, you want to think about that money as being locked up in the 401k while you're still working there for the most part. You might have access through loans or hardship withdrawals or in-service distributions, but for the most part, that money is going to stay put while you're still working. The investments are also generally the same. So if you have a certain set of investments you've picked on the traditional 401k side, it's going to be the same list of investments on the Roth 401k side. I haven't seen 401k plans that really allow you to do that separately. Sometimes, especially if you're doing an individual 401k, you can set that up. But with most employers, you pick one investment mix, and that's going to apply to both types of money. So before we do more nuts and bolts and pros and cons, maybe an example would help. So we've got your current tax rate and the tax rate you have in retirement. This is one of the ways people evaluate this decision. When will I be in the lower tax bracket? So if they're the same, we're going to see that mathematically it won't matter, but that ignores all that stuff about healthcare premiums and Social Security taxation. So let's say that you have $20,000 in your budget available for something. Maybe it will go to a pre-tax contribution, or maybe it'll go to Roth and cover the taxes that you're going to pay if you do that. So you've got 15 years until retirement. You're going to earn 5.5% per year. So if you go with the pre-tax contribution versus Roth, you're going to have zero income tax on that $20,000 because you're deferring the income, essentially no federal income tax. So you put the entire $20,000 into your 401k, it grows over those 15 years to be $44,000, but you do have to pay those taxes at some point. So when you take it back out at a 25% tax rate, 25% of this 44k is about $11,000, leaving you with $33,000 that you can go ahead and spend. If we go over to Roth with these same assumptions, it's going to cost you $5,000 in taxes. Again, that's 25% of the $20,000 that you put in there. And then only $15,000 of your $20,000 goes into the Roth 401k. That's okay. It grows at the exact same rate. We've got the exact same assumptions for investments and becomes $33,000. But when you take the money out, we assume that you satisfied all of the IRS rules, so there is no tax due on this qualified distribution from a Roth, and you end up with, in this case, that exact same $33,487. Where it really gets important is, let's say you might be in a lower tax rate in retirement, so we'll say 15% in this case. So in that case, the tax here on the pre-tax contribution was less, which leaves you with more spending money on that pre-tax contribution. So this is the traditional assumption where a lot of people say I should do the pre-tax contribution. Again, it ignores all of that stuff about the healthcare and the Social Security taxation, etc. The opposite could also happen. Let's say that you're in a 15% tax bracket today, and then it's 22% or something later, just various combined taxes, federal and state or whatever. But in that case, if you are in the lower tax bracket today versus a higher one in retirement, you're going to see that you end up with more spending money after tax using the Roth option. So this is one of the factors of the decision. What is my tax bracket today versus later? By the way, I'll have a link to this calculator or something equivalent in the description below, so be sure to check that out so you can play with your own numbers. And this is just a single contribution. A lot of calculators online show you, what you'll have at retirement with every year, and I'm not sure that's helpful to know that you'll have, X million dollars, because really it comes down to each year's choice. And by the way, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. And in the description below, like I said, you can see that calculator. There will also be some big picture retirement planning things. If you're asking these questions, I think that information is really going to be helpful for you, so be sure to check that out. And friendly reminder, this is just a short video. We're not covering everything. Please triple check with your tax expert and your plan administrator so that you can make the best decisions. Looking closer at contributions, when you make those pre-tax contributions, it's going to reduce the amount of income you report in taxes. So what happens is in box 1 of your W-2, you will have a lower number than what your actual earnings are, so the number will be reduced by what you put in as a pre-tax contribution. Now you still do need to pay FICA taxes. So for example, payroll taxes for Medicare and Social Security, the income must be subject to those taxes, but you can avoid income tax. That's not necessarily the end of the world because those taxes go toward your eventual Social Security benefits. So sometimes people like to keep their income as low as possible because they don't want to pay payroll taxes, for example, but that might mean you have a smaller Social Security benefit in retirement, and Social Security is quite helpful. It's government guaranteed, inflation adjusted, and for your entire life. Those Roth contributions do not reduce your taxable income, so you will see your full amount of income on your W-2, but the employer takes that money and puts it into the 401k for you, much like another type of after-tax deduction from your paycheck. And again, on matching, you're not going to miss out on anything if you choose one or the other. Now, traditionally, all of those matching dollars went into pre-tax accounts. But with Secure 2.0 legislation, it is possible for employers to put that money into Roth-type accounts instead of pre-tax accounts. It may take a couple years before everybody gets that up and running, but it could be an option for you. Now let's look at those distributions. So when you have two types of money in your 401k, the record keeper, or the place where you log in and do your investments and all of that, is going to track that money separately. So effectively, you have two buckets of money in your 401k, and let's say you leave your job and request a rollover, you're going to move that money into an IRA, for example, you would generally get two checks, and one of those is for the traditional pre-tax money, the other is for the Roth type money. And as you might expect, you would generally put the traditional money into a traditional / rollover IRA, and the Roth type money goes into a Roth IRA. Now you could potentially take the traditional money and do Roth conversions with that, but that's a different video. So Roth 401k distributions can get a little bit tricky. Again, the idea is to get tax-free income in retirement if all goes well, if you satisfy all of the rules for a qualified distribution. So that means being over 59 and a half, having the money in there for at least 5 years, and a few other situations could apply. But that 5-year rule is important to pay attention to. So for example, if you wanted to put your money into an IRA and spend it from there, it's important to think about opening and funding a Roth IRA outside of the Roth 401k. So you can start the clock ticking over it wherever you have your IRA. Doesn't matter. You can pick a brokerage house or a bank or something, but you open it up and you fund it so that the clock starts ticking. Then when you move money out of the Roth 401k into the Roth IRA, it takes on the age of that IRA. You can also potentially use other older IRAs as well, Roth IRAs, to satisfy that 5-year rule. Now, another biggie with Roth versus traditional is RMDs, required minimum distributions. At some point, the IRS requires you to take money out of pre-tax accounts so that they can eventually become taxable dollars and generate some revenue. But with Roth-type money, you generally don't have the RMD as long as the account owner is still alive. Now, in the past, Roth 401k did have an RMD. Again, the recent legislation of Secure 2.0 did away with that, or does away with that. So that's not necessarily a concern anymore. But this is an important consideration if you're evaluating, should I make Roth 401k versus traditional contributions? Think about those RMDs. You also need to think about distribution. So since Roth 401k can get so complicated, it may make sense to move money to a Roth IRA. There are always pros and cons of moving money from a 401k to an IRA or vice versa. So this isn't, the entire answer, but this is one ingredient in the decision. So with Roth 401k, the money comes out pro rata if you're not taking a qualified distribution. In other words, one of those tax-free distributions. So for example, let's say you have $100,000 in Roth 401k and 80,000 of that is from your contributions and the remaining 20,000 is earnings. So if you take a hardship distribution of $10,000, let's say, and you're 50 years old, you would have to take out both the basis and the earnings proportionally. Again, that's unlike a Roth IRA, which might allow you to take the most favorable dollars out, in other words, just the basis with no earnings. With Roth 401k, you have to take it out proportionally. So in this example, you would get $8,000 of basis and $2,000 of earnings, and that earnings portion might be subject to both taxes and early withdrawal penalties. Again, that's proportional to the $100,000 made of 80,000 contributions and 20,000 of earnings. We just took away a zero. Now let's talk about traditional 401k distributions. Those are generally included in your income as it's ordinary income, but any deductions or credits could potentially reduce the ultimate tax liability you have. It's really important to recognize that you probably can't spend every penny from your pre-tax retirement accounts, or if you do, you're going to need to come up with the tax payments from somewhere else, maybe your taxable accounts. And that's because when you take distributions from those pre-tax accounts, it goes onto your tax return as ordinary income. So maybe you do tax withholding when you take the money out. You have maybe your IRA or your 401k provider just send some money to the IRS at the same time as they send it to you, or maybe you settle up later in the year. There are pros and cons to each choice. You really want to be mindful of not having underpayment penalties, so you do want to evaluate whether you do withholding or make some estimated tax payments throughout the year. But ultimately, you want to think of these pre-tax accounts like a bag of chips. So you see the bag and you reasonably assume it's full of goodness, it's all packed full. But when you open the bag, you find that you can only eat a portion of the volume you were expecting, and the rest of it is air. So similarly, your pre-tax accounts are a sizable resource that looks like you have a ton of money, but it's important to budget for some of that money going away as tax payments because you won't be able to spend it all without consequences. Or, if you're not a fan of food analogies here, think about it like your salary versus your take-home pay. So you earn X, but when you get your paycheck, it's typically less than that after those taxes and deductions. So glancing at some pros and cons of traditional versus the Roth 401k, the Roth gives you the potential for tax-free income in retirement if you meet those requirements for the qualified distributions. And, this isn't just about your income tax. It can also help with your medical expenses and other things on your tax return. And you get to contribute regardless of your income as long as your plan allows for these types of contributions. The drawback is going to be that there's no immediate tax benefit. So if you're struggling to save money or you can't afford to maximize the match from your employer, then a pre-tax contribution might make more sense than a Roth contribution. When it comes to the traditional, that one gives you a current year reduction in your taxable income, and that is especially helpful in those high income years or if you're a high income earner. But you will need to pay those taxes eventually, so keep that in mind, especially as you watch those account balances grow. And remember that RMDs may force you to withdraw more than you wanted for taxation, although you can just reinvest the money or make donations or take other steps to manage those RMDs. Unfortunately, it's really hard to predict the future, so your income might change or maybe tax rates would change based on the exact same income level. We don't even know, or even bigger shifts could occur. So whether or not you think it's likely, it's even possible that the U.S. could move toward a sales tax or consumption taxes as opposed to relying only on income taxes. So might not be a big shift, might be a minor shift, who knows? The future is uncertain. So which is best and which one should you choose? Let's start with Roth. This one might make the most sense if you're in a relatively low income tax bracket today, or maybe you have years in which your income's kind of low. You changed jobs, you spent some time out of the workforce For example, it could be a nice idea to make Roth contributions. Also, if you expect higher tax rates later in life, whether that's due to having more income or just different tax rules, then Roth might make sense. Again, expecting higher income tax rates. Or you could be concerned about means testing. And this is when you have a high income and that has negative impacts on you. So, for example, those IRMA surcharges when you pay extra for Medicare because your income's too high, or more of your Social Security becomes taxed, or you lose certain deductions and credits on your tax return due to having a high income, or you're worried about big RMDs coming out later in life. Those might point toward using Roth 401k. Roth can also be good for super savers who want to just maximize their tax-favored dollars. So if you have plenty of cash flow, you're debt-free, you've taken advantage of every other opportunity out there, maxed out your HSA if available and everything else, and your priority is just to set aside potential tax-free money for yourself and loved ones, then again, that points toward Roth. And another one for Roth is just tax diversification. So you are probably heavy on pre-tax money if you're like most people out there. So if you spend your entire life saving in those pre-tax accounts and getting matched in those pre-tax accounts, you could have some of those challenges later in life. Again, the big RMDs or more of your Social Security being included in your income, higher Medicare premiums, etc. So that's Roth. Now, when does the traditional pre-tax contribution make the most sense? Well, as you might imagine, that's when you have a relatively high income and you're currently in a relatively high tax bracket. It could also work if you're not overly concerned about all of these income problems down the road, and that might be the case for somebody with, let's say, $300,000-ish saved for retirement. That amount of money isn't necessarily going to cause a huge RMD problem or make the majority of your Social Security taxable or make you pay higher healthcare premiums. And you might also just prefer certainty. Some people say, I want the bird in the hand, again, that certain tax deduction today versus the two in the bush, or the hope for that potential tax-free income later in retirement. You just want some certainty and get what you can today, and you'll figure out the rest later. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.